Go through the numbers, if you would do, and tell us where you saw the gains and what you're seeing right now in your business.
Well, no, great to be on the programme. Look, we've just announced a strong set of results, which have been based, I think, on a solid operating performance. And yes, we've had some higher prices, as you mentioned there in your introduction. If you cut all the way through to it, we're left with a free cash flow of $10 billion. That actually makes it $35 billion of free cash that we've actually generated in the last 3 years, roughly about $1 billion a month. And we've been able to return a significant amount to the shareholder. As you mentioned, the final dividend is 78 cents a share. That's about $4 billion. And that's in addition to the $17 billion we've actually returned to the shareholder this year. So I think it's a very good result for the shareholder. And I believe we're now on a very good setting for the future. This is an outcome that's been based on many years, quite a few years of hard work in getting the balance sheet strong, in getting the portfolio in the right shape, and actually delivering an organisation that's capable of world-class performance in both the way in which we operate those fine assets that we've now selected, but also in investing capital. And so as we look forward, I think we can see a continuation of what we've been able to deliver so strongly in the year just concluded.
Andrew, aren't you between a rock and a hard place here? Because on the one hand, people will accuse you with this record dividend of being profligate, and you'd have other people saying you should actually, you could afford it, so that's why you should do it. And you've chosen, of course, the fact that you can afford it. But let me just take that side as a devil's advocate and say, in these times of turbulence with a trade war, shouldn't you be perhaps retaining more money in order to see off the battles ahead?
We've pitched the dividend, I think, right between the two bookends that you described. We have, a low level of gearing, 15%, and in the last few years we've become much more flexible in the way in which we're able to direct our cash. And that cash, of course, is being put to ever greater use. We can continue to grow this company strongly, at a rate of expenditure in the near term of around $8 billion a year. That's down dramatically from what it was, not so many years ago. We would have had a number more than 20. And we have a program in place right now to continue our reduction in costs and our increase in efficiency. That's already been quite, I think, quite spectacular in my view. But we've renewed things. So we're using a lot more technology now. We're lifting the performance of our people and their capability. And so I would say with our strong balance sheet, with a very flexible way in which we're able to use our cash, we're ready for whatever the world might throw at us. And we can profit from a downturn, but we can also, I think, throw off a lot more cash potentially in an upturn.
Andrew?
But in all of this, I think there will be a bias to good cash returns to the shareholder.
Andrew, is the dividend sustainable? I mean, will you give a guarantee to shareholders that this is sustainable for an XX period of time?
Well, we don't have a fixed dividend or a progressive dividend. I mean, quite early in my tenure, we changed it to a flexible dividend, and it's based on a payout ratio of 50% on underlying earnings. And so it will go up and down depending on how markets perform. We have a portfolio that smooths our cash flow and our earnings, and so that will smooth the dividend, but not completely. And if markets turn down, then of course our earnings will go down, and the dividend that we commit to pay will go down as a consequence. It's one of the many tools that we have, to sail through what might be choppier waters in the future in the way you've described. And that's why we're very comfortable in paying this record dividend today.
The trade war naturally could be quite damaging to the Chinese economy. Are you concerned about that?
I would put it more broadly, if I may. I mean, as it turns out right now, the demand for our products going into China, is growing rather than slowing. for their plans, and indeed some of the plans that they might put in place to mitigate the impact of trade, of increasing investment in things like infrastructure. It means they need more of the iron ore, the met coal, and potentially the copper that we produce, potentially more energy in the form of LNG or oil. And so we don't see any short-term impact, quite the reverse. We see a bit of increase in demand and also a flight to quality as they want to have products that will have a better environmental performance. I think the bigger issue is that the trade war is symptomatic of a number of things that are happening around the world, which in my view are quite negative towards capitalism and globalization, free trade, free markets and free competition, which we as BHP stand for very strongly. We stand for that because we believe that is a driver of wealth creation. And the more that governments think that they can intervene more in industry, threaten the independence of their banks, then the bigger risk that they're placing on broader global economic growth, not just in China and the US, and that ultimately, of course, will mean there's less demand for our products, but also it means
Andrew,
people become less wealthy, there'll be more people trapped in poverty, and it is something we're going to have to speak up against.
Now, iron ore, I think, accounts for about half your EBITDA. Do you think that you've got too many eggs in one basket with regards to that? And what about your outlook for iron ore? Because it has, in the whole commodities complex, been a bit of an outlier, been on an absolute tear this year.
That's true, but it is less than half. We have competitors where it's a much bigger part of their EBITDA, and we have the other parts of our portfolio, like oil, like copper, like coal, which make up the other half. The portfolio effect is working for us. Right now, we're enjoying a strong performance from iron ore, but potentially a weaker performance from copper, and to some extent oil. Met coal, which most of our coal is enjoying a bit of the increase in demand for steelmaking within China, and therefore some higher prices. But if the world changes and we see, for example, more unrest in the Middle East, that may have some depressing effect on some parts of the world economy. Higher oil prices would be the driver for that. But we have an oil business that is actually performing very well at the moment, and it's designed longer term. We have investment options in things like potash and in nickel, which we think are going to be particularly attractive in a world driven by more decarbonisation and along with
Absolutely,
copper by
Andrew.
more electrification.
Andrew, the reason I was asking that question is because of exactly what you just said, which is you've got some $25 billion worth of potential growth options here, including the likes of potash and copper. Can we expect in, let's say, 5 years' time to have a very different looking BHP?
I think 5 years is too short, but 10 years, potentially, yes. And of course, within 5 years, you could certainly see a big change in the percentage EBITDA from the individual products. We've seen these kind of swings in a 5 to 10 year horizon quite regularly in our company, and of course, we will plan accordingly. I mean, you're right. We have a lot of growth options underway. We've got 6 major projects in oil, copper, iron ore, and potash. They're all on time and on budget. And the average expected return from these projects is around 20%. And we have a lot of minor projects as well, which tend to have the higher returns. So yeah, we are a company that very much flows with the world, Andrew, and changes our commodity mix and our investments as to how we see the world going.
Andrew, I just haven't got much time, so please can I just ask you for a degree of brevity? The thing is, you just highlighted organic projects as such. What about inorganic growth? Are you looking for opportunities briefly?
We regard that as something that we have to be very opportunistic about. We think it's better to grow our business organically and through successful exploration. And we have exploration in copper and oil that is going very well at the moment. We've seen reserve additions and discoveries in the last few years that will create more opportunities for growth that are more attractive than inorganic activities.
Thermal coal, what are your options there at the moment with those assets that you have in, as you just talked about earlier, people are becoming more and more aware of the environmental damage of certain types of energy sources?
Well, energy coal is only about 3% of our portfolio. We have two coal mines, one which serves the Pacific market, one which serves the Atlantic market. They're both right at the bottom of the cost curve. And of late, they've been strong returning businesses which have thrown off a lot of cash. Coal's come off a bit. We're very clear that in the longer term move to deal with, if you like, the challenges, the emergency of global warming, then the world will have to steadily move to a lower proportion of coal within its energy mix, and therefore the demand is likely to be less strong in a commodity that is very well supplied. So we're not likely to invest in energy coal going forward, but we'll time how we handle the value and the valuation of those assets into the maximum benefit of the BHP shareholder.
Andrew, just seeing a couple of headlines just drop at the moment, and they are not from Bloomberg. One is minor miracle. BHP's Mackenzie pulls off clever game to beat rival Rio. We've got you also by somebody else saying you're a tougher act to follow. You've just made yourself a tougher act to follow. Will you be also announcing results this time next year?
I'm not going to get into the succession. That's a matter for my board, and they would have to talk to you about that. And I serve at their pleasure. But I'm having a lot of enjoyment right now in my job. We've effectively launched another big move to transform the underlying performance of our company. We're further simplifying the portfolio. I have a lot of energy for it, and the other question you need to ask my board.